Welcome back to the channel. In today's video, we are going to break down the latest technical and sentiment outlook for Near Protocol in a way that is simple, clear, and easy to follow, even if you are not sitting in front of charts. Right now, Near is in a very interesting phase where different analysts and technical indicators are not agreeing with each other, which is creating confusion in the market. Some signals suggest weakness and the possibility of another drop, while other signals are still pointing toward a potential bullish continuation if key levels are broken. So in this video, we will go through both sides of the argument, explain what the indicators are actually saying in simple terms, and understand the possible scenarios that traders are watching very closely around the $2 zone. No charts needed, just pure explanation so you can understand the bigger picture clearly. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. To start with the cautious view, Anton Haratonov from Traders Union is highlighting some warning signs that cannot be ignored. According to his analysis, Near is currently trading below its MA20 level, which is often seen as a short-term trend indicator. When price stays below this level, it usually suggests that the market is still under pressure and buyers are not fully in control yet. Even though there have been some recent recovery attempts, he believes these moves are not strong enough to confirm a stable uptrend. One of his main concerns is that there is no strong fundamental news or external catalyst supporting this bounce. In crypto markets, rallies often need a trigger, such as new partnerships, ecosystem growth, or macro improvements to sustain momentum. Without that, price movements can become weak and short-lived. He also points out something important from momentum indicators. Oscillators are tools used to measure whether an asset is overbought or oversold. And in Near's case, there is a divergence happening. This means different indicators are giving conflicting signals, which usually reflects uncertainty in market direction. Alongside that, bull-bear power is still negative, meaning sellers still have more influence than buyers in the short term. Even if price is rising slightly, selling pressure is still present underneath the surface. Because of this combination, Haratonov remains skeptical about the strength of the current rebound. In his view, if buying volume does not increase soon, Near could easily lose momentum again and potentially retest lower support levels before any stable recovery begins. Now, shifting to a more optimistic perspective, Viktoras Karapetchans presents a more constructive outlook on Near's current structure. Unlike the cautious view, he focuses more on higher timeframe indicators rather than short-term fluctuations. According to his analysis, Near is currently trading above both its MA50 and MA200 levels. These are important moving averages that represent medium-term and long-term trends. When price holds above them, it often indicates that the broader structure is still bullish, even if short-term volatility exists. From his perspective, this is a sign that Near has not lost its overall bullish foundation yet. Even though the market is volatile and news flow is limited, the price action is still showing resilience. He believes that this type of structure often leads to breakout opportunities once momentum returns. In particular, he is watching the $2.26 area as a key resistance level. If Near manages to break above that level with strong volume, it could signal the continuation of a bullish move and possibly open the door for further upside expansion. Karapetchans also emphasizes that markets do not always need constant news to move. Sometimes technical structure alone can guide price action, especially when key levels are being respected. In his opinion, the presence of two major weekly buy signals suggests that buyers are still active in the background, and this could eventually lead to another upward push. However, he still acknowledges that confirmation is necessary, and that breakout validation is the key factor to watch before assuming a strong uptrend continuation. Adding another perspective, market strategist Janam Mehta focuses more on short-term trading behavior and intraday uncertainty. According to his view, Near is currently in a phase where direction is not clearly defined, and price movements are being driven more by short-term speculation rather than strong trend momentum. He describes the current situation as a flux phase, meaning the market is temporarily unstable and reactive rather than trending. Mehta identifies a key trading range between $2.10 and $2.26. This range is very important because price is currently moving inside it, and neither buyers nor sellers have gained full control. In such conditions, traders often rely on range trading strategies, meaning they buy near support and sell near resistance until a clear breakout occurs. He believes this environment will continue until Near breaks decisively above resistance or falls below support. He also mentions that oscillator divergence is opening the possibility of a contrarian move. In simple terms, this means that even though indicators may look weak or confused, momentum could suddenly shift in the opposite direction if buying pressure increases quickly. If NEAR manages to build strength above resistance, it could trigger a faster than expected bullish move because many traders are currently positioned cautiously. Now, looking at the broader technical picture, multiple indicators are sending mixed signals at the same time. On one hand, MACD and ADX are showing signs of positive momentum, which typically suggests that a trend is trying to form or strengthen. These indicators are often used to confirm whether a move has strength behind it. On the other hand, RSI, stochastic RSI, and CCI are still showing conditions that lean toward oversold territory. This means that while momentum might be building slowly, the market has not fully recovered from previous selling pressure. At the same time, bull-bear power remains negative at around 0.1213, which is another indication that sellers still have short-term dominance. Even though price may be recovering slightly, the underlying pressure has not completely disappeared. Volatility is also relatively high, at around 4.71%, which tells us that price swings are still active and unpredictable. In such conditions, sharp moves in either direction can happen without much warning. From a structural perspective, there are two major resistance levels that traders are paying close attention to. The first is the MA20 level, around $2.2761, and the second is the Ichimoku Kijun level, near $2.2780. These two levels are very close to each other, creating a strong resistance zone. If NEAR approaches this area, it is likely to face selling pressure, unless strong bullish momentum enters the market. On the downside, the MA50 level, around $1.7706, is acting as a more stable support zone. As long as price remains above this level in the medium term, the broader structure can still be considered relatively stable. What makes the current situation more interesting is the contradiction between different indicators. Some tools are suggesting that momentum is building, while others are still pointing toward weakness or exhaustion. This type of divergence usually appears during consolidation phases, where the market is preparing for a larger move, but has not yet decided the direction. In many cases, this leads to either a breakout or a breakdown once volume enters the market strongly. Earlier observations from analysts also support this idea of uncertainty. They have already pointed out that NEAR has been showing mixed momentum behavior for some time, and traders should be cautious about assuming a clear trend too early. Instead, the market is more likely to remain range-bound or volatile until a decisive breakout occurs. This reinforces the importance of watching key levels rather than reacting to small, short-term price movements. So when we combine all of these viewpoints together, a clearer picture starts to form. On one side, there is pressure from weak short-term indicators, negative bull-bear power, and lack of strong fundamental news. This supports the idea that NEAR could still face downside risk, or at least more sideways movement. On the other side, higher timeframe structure remains relatively intact, with price still holding above major moving averages and some indicators showing early bullish momentum. This creates a situation where the market is essentially waiting for confirmation. If NEAR breaks above the $2.26, $2.28 resistance zone with strong volume, it could trigger a bullish continuation and open the door for further upside movement. However, if the price fails to break this zone and instead loses the $2.10 support level, then a deeper correction or retest of lower levels becomes more likely. In conclusion, NEAR protocol is currently at a very important technical decision point. The market is not clearly bullish or bearish right now, but instead stuck in a zone of uncertainty where both outcomes are still possible. Short-term indicators are showing weakness and indecision, while medium-term structure is still holding a bullish bias. This is why analysts are divided, with some expecting a breakout and others warning of another pullback. For traders and viewers, the most important thing right now is not to predict aggressively, but to watch the key levels carefully, especially $2.10 as support and $2.26, $2.28 as resistance. Whichever direction breaks first with strong momentum will likely define the next major move for NEAR. Thanks for watching. If you enjoyed this video, make sure to like, subscribe, and turn on notifications so you never miss the next update. See you in the next one.